Greetings, option traders. In today's video, I'm sharing a short but valuable lesson from one of our community members, Ian. He'll show you a strategy originally introduced by JR on our channel, which you can find in our RG multi-leg channel for advanced options traders. I hope this helps you understand how JR manages his portfolio. Huge thanks to Ian for this guest video. Let's dive right in and hear what he has to say. And remember, if you'd like to share a video of your own option strategy, you're welcome to post it in our Member Strategies Discord channel. Enjoy!
Hi guys, my name's Ian. I live in Lancashire in the UK, and for the last 6 months or so I've been learning a strategy which has been shared by JR in the Discord room, and I found this to be a good starting point for live trading when learning the strategy. First, we need to do the disclaimer, so refer to section 5 in the Tanuki Trade rules and the info section. In particular, I am not an investment advisor and nothing posted here constitutes investment advice. In this video, I share my personal experience only. I am not affiliated with Tanuki Trade, JR or anyone else, and I am not selling anything. I am just sharing my understanding of the methods that I am using. I learned from others and I'm still learning, so hopefully you will too. So the trade strategy is a multi-leg portfolio, consists of multiple diagonal spreads. It's based on backwardation mode, so the volatility of the front expiration must be greater than the volatility of the back expiration. This can be seen in the options overlay indicator, which is highlighted in blue, I think, because I'm colorblind, and it's in the next slide coming up. Number 2, directional trading. The first diagonal spread is a credit call diagonal spread on a move down, then a credit put diagonal spread on an up move. The second diagonal spread should close profit on the first diagonal spread. Portfolio changes: closing profit on a long put stroke call on the change of direction, closing profit on a short put stroke call on change of direction, with target opening another short put call with a larger premium. 3, lifting break even at risk. You do this with either another credit diagonal spread or a long put stroke call in the money. 4, tracking Greek variables. The delta, standardly about neutral, always overnight or longer periods of inconvenience at the PC. Positive delta when using directional trade up, negative delta when using directional trade down. Theta wants to be as large as possible, protects us from price changes, and vega must be smaller than theta, which helps to protect against changes in volatility. So the backwardation mode that I just spoke about in the previous slide, you can see here in the Tanuki Options GEX Pro indicator, and we have backwardation between the 24th and the 21st of February, highlighted in probably blue. And I would use this as the basis to structure the trade. So I look at the Friday expiry, 21 days to expiry, to plan where to put the strikes. I usually try to use big numbers on the front month, as they tend to have more volume traded. So the 6,000 put and the 6,100 call. The distance between the strikes is variable depending on a person's trading style and account margin. I currently favour 100 points between the front month strikes, with extra diagonals added 50 points away. So when entering a new trade, we would normally look at going 2 weeks out to get a good amount of credit, and normally entering on a Friday works well as you benefit from theta decay over the weekend. I look for a credit of about $900 to enter the first double diagonal. Depending on volatility, this can vary. In the trade that I'm showing, which was traded live, the entry was on Monday the 10th of February for a 780 credit, with expiries on Friday the 21st and Monday the 24th of February. My plan is always to close the whole trade on the Friday expiry. So looking at the option strat example, we can see the credit we received on entering the trade, our max loss, max profit. Option strat also displays the break-even points, which we will defend if necessary as the spot price moves around. These figures will change as the volatility moves up or down. It is possible to put the portfolio on, and if the spot price remains within the tent, it would make a nice profit without making any changes. However, if the spot price moves, which we expect it to do, there will be opportunities to take profits along the way to expiry. Now the trade is live, I monitor each diagonal on a watch list on my account, and I treat each diagonal separately. I'm looking for opportunities to take profits on the short legs and coincide this with a chart signal that will give me the best chance of success. As I've been learning the strategy, I look for reversals at high GEX levels. If we're going up, I want to hit or get close to call resistance, and then get signals on the chart to confirm a reversal. The same with a down move, although caution needs to be exercised, as sometimes a move to put support can be accelerated downwards by the market maker shorting and pushing it even further down. Some days I will not even take a trade if I am not happy with the signals and the portfolio is in good shape. So here's an example of a good entry point. As the spot price moves around, you will see the prices move up and down together. Using GEX levels combined with a good charting package, we need to spot points where the market will stall and turn around so that we can benefit from this. This example from Thursday the 13th Feb shows a really good example. As the spot price hits the highest call resistance, the price reverses and the chart signals confirm this. Of course, they don't always work like this, and there are occasions when, after covering a short put for profit, I am expecting the spot price to increase, which will allow me to re-enter at either a higher price or enter at a lower strike to capture more premium. If the trade is not working, I simply re-enter the trade for a few dollars higher, which will keep the portfolio close to delta neutral. When you need to add a second diagonal to protect your break even, there are a few ways to do this. Personally, I like to put them on as cheaply as I can. So on a move up, I will try and get the put diagonal on, and then on a move down, do the same with the call diagonal. This shows the addition of the put diagonal, which has added a lot of downside protection. If we now get a big move up, I will need to protect the right side, so we'll have to pay more probably for the diagonal. This is what I'm just talking about, lifting the left break even. So this move allowed me to buy back the 60-15 put for $18, which had originally sold for $31, so I took $1,300 profit, and then sell the 6,000 put for $16, which lifted the left side break even. I also model each diagonal separately in option strat, and these shots show the effect of moving the left break even. When we are trading, a lot of the times you look at a chart, you look at your strategy and you think, all I need to do is do this, do that, and I'll make some money. Doesn't always work like that. And in this live trade, this was my mistake. So having watched the market test the 60-30, 60-50 area on numerous occasions over the last few days, we then hit a new all-time high. And normally when this happens, profit taking kicks in and we sell off. So my trade has hit my topside break even, so it must come back and sell off big style. Wrong. I am now on the wrong side of break even with 2 days left in the trade, looking at a potential 2k loss. Why did I not add the call diagonal? The trade should have looked like this. The addition of the call diagonal would have lifted the right size and minimized the loss if the market stayed up at the highs. However, I hadn't put the trade on, so I'm faced with a problem and need to fix it. And this is why we trade options. We roll out the call diagonal to a future date. I paid $1 to roll out to the 17th, 14th of March, so 3 weeks out. And now I have time for either the market to fall back or I can trade myself back into a profit. So Friday morning comes, 21st of February, expiration day, and as the market opens on Friday, this is the situation. Worst case scenario, we lose about $500, but nobody knows what the day will bring. Remember, most analysts are right 50% of the time. So the drop I have been waiting for all week finally arrived. I had 2 put spreads left on, and I watched the chart as I was planning where I needed to get out of the trade. First target was highest negative net gex support at 60.50, but we blew straight through that. So next put support was at 60.40, and as we were getting multiple buy signals on the chart, I covered my short puts first, then sold the long puts. The call spread had been rolled out, so that was simply removed from the trade and transferred to a new trade at the original cost, which was a 6.40 credit. So deduct $1 to roll it out, it still stands at a 5.40 credit. We can see the range over the time the trade was on was only 100 points, chopping up and down, with some days having a 20-30 point range. For me personally, that is not enough range to take a trade, and I would rather let theta decay do its job. With hindsight, I didn't need to roll out the call spread, as it would have made a nice profit. With even more hindsight, I should have put the extra call diagonal on while I had the chance. The call diagonal that I rolled out will be used to construct a new portfolio 3 weeks out. So at the end of the day, this is where we stand. The market came down nicely, the put spreads were closed, and we closed the trade with a $1,256 profit. And what happened to the call diagonal? So the call diagonal that I rolled out, the 6100 6080 call diagonal, has started a new trade, and with the addition of a 6000 6015 put diagonal, we have the start of a new portfolio. The put diagonal was put on for a 225 credit, and the original call diagonal stands at 545 credit, so the total credit on the portfolio is currently $7.65 credit. The last trade that I've been talking about had a credit of $7.80 when we started. So very much in the same position. And as I'm making this video on Friday the 28th of February, the market has dropped even more. We're now trading in the 59.75 range. So the decision to roll out the 6100 6080 call spread was the right decision at the time, but if it didn't work, you can roll it out again. Anyway, I hope everybody's learned a bit from that. As I said, I'm still learning, and thanks for listening.
Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.